Welcome to vTalkInsight, Market Drivers Daily for July 30th, 2026. Long-end bond yields have broken to multi-decade highs just as big tech delivers blockbuster earnings and Middle East tensions push oil back above $90. Today is about how that combination reshapes risk pricing across rates, equities, and energy. The core macro driver right now is a bond market that no longer fully trusts central banks to control inflation and is expressing that doubt through the long end of the curve. 30-year U.S. Treasury yields have pushed up to around 5.2%, the highest since before the financial crisis, and similar levels are being referenced repeatedly across global markets. Only a few sessions ago, the probability of further Fed tightening around upcoming meetings was closer to 1 in 3. Now markets are pricing roughly two-thirds odds of a September hike, with some curves implying a full additional move by October and several more hikes embedded in two-year Treasuries. This repricing is showing up as a pronounced steepening of the yield curve, led by the back end. The spread between 2-year and 10-year yields has widened markedly over the past month, with front-end yields softening even as long-dated yields make fresh highs, a classic bear steepening pattern. Across the Atlantic, similar dynamics are visible. 10-year gilts and other longer-dated bonds in economies perceived as behind the curve, such as the Bank of England or Bank of Japan, have underperformed as term premia rise. Officials estimate that quantitative tightening explains only a small fraction of the multi-hundred basis point move in UK 10-year yields since early 2022, which suggests markets are demanding a structurally higher inflation and policy risk premium. These yield levels are no longer just a rate story. They're tightening financial conditions in ways that matter across portfolios. Long-term U.S. yields are now at 19-year highs, raising debt service costs for governments and corporations and constraining fiscal flexibility, especially in Europe and the United States. Higher real yields are increasingly cited as the main driver of the move, rather than a jump in inflation expectations, which makes the tightening more potent for valuations in long-duration assets. Equity markets are beginning to feel that pressure, particularly in Europe and in rate-sensitive growth segments where elevated bond yields, tighter liquidity, and concerns about a potential credit or liquidity event are feeding into higher risk premia. The policy backdrop amplifies this move because communication has become less predictable and, in many eyes, less credible. The latest Fed press conference is widely viewed as having undermined confidence. The chair reaffirmed the inflation target but avoided clear guidance on September, and markets perceive the tone as softer than the underlying hawkish voting pattern. That mix of firm rhetoric, dovish action, and a shift away from explicit forward guidance has pushed investors to test the Fed, steepening the curve and forcing long-end yields up as markets demand concrete hikes rather than verbal commitments. Similar unease is visible in the United Kingdom, where a 6-3 vote to hold rates and talk of sufficient restrictiveness coexists with inflation still projected above 3% in adverse scenarios. There is, however, a credible counter-narrative that sees the current bond sell-off as potentially overshooting fundamentals. Core PCE inflation has eased to around 3.3% year-on-year, and monthly prints are moderating, which suggests price pressures are gradually abating even if they remain above target. Several policymakers argue that policy is already restrictive enough and that much of the additional tightening is now coming from higher term premia rather than from the policy rate itself. Market pricing in some regions reflects this, with expectations for only modest additional hikes by year-end unless there is a clear resurgence in second-round inflation effects. From here, the key watch points are the next inflation and labor prints into September and how they intersect with these elevated yield levels. Upcoming FOMC meetings are effectively live even if the Fed ultimately holds, because the bond market has become the primary transmission channel and could force the central bank's hand if 10-year yields push toward the 4.75 to 5% zone flagged by several participants. For cross-asset portfolios, the interplay between this higher for longer rates regime and the ability of earnings, especially in technology, to absorb a higher discount rate will be central to performance. That takes us straight to today's earnings picture, where a handful of megacaps are doing much of the heavy lifting. Corporate earnings are, for now, cushioning some of the macro shock coming from rates and geopolitics, but the leadership is narrow and the bar for good news is high. Strong results from major technology and consumer names are supporting headline equity indices even as bond markets wobble, while misses or cautious guidance are being punished disproportionately. Microsoft sits at the center of that story. Azure revenue growth has re-accelerated to roughly 43% year-on-year, its fastest pace in several years, helped by rapid adoption of AI tools such as Copilot, which now counts around 30 million paid seats. The company is demonstrating pricing power and fiscal discipline, with over $20 billion in free cash flow, and investors have rewarded this with the largest single-day gain since the late 2000s, lifting the Nasdaq and S&P futures despite the rates backdrop. Amazon Web Services is also surprising to the upside, with cloud sales growing in the high 30s and margins improving even amid heavy AI-related spending, supporting a strong aftermarket rally in the stock. Outside of cloud, earnings strength is broad but uneven. Starbucks is reporting nearly 8% comparable sales growth, driven by more visitors and higher average tickets across all income and age groups, and is accelerating a capital-light store revamp program that links operational improvements to higher throughput. Shell has delivered close to $10 billion of adjusted profit, well ahead of expectations, helped by robust refining margins and volatility linked to Middle East tensions, and has announced additional share buybacks as capital returns remain a priority. In semiconductors, Samsung has posted a dramatic profit recovery, with earnings up roughly 250-fold on the back of high-bandwidth memory demand and AI data center build-out, while positive chip reports have driven the Philadelphia Semiconductor Index to an 8% single-day gain even though the sector is still down sharply for the month. At the same time, markets are making clear that beats alone are no longer enough when expectations are elevated. Meta, Qualcomm, and several consumer and leisure names have seen their shares fall on softer revenue outlooks, cost concerns, or guidance cuts, even when current quarter numbers were solid. Examples include Crocs, which sold off despite raising guidance after a strong rally, and travel-exposed companies like Norwegian Cruise Line, which blame softer bookings and Middle East conflict for weaker prospects. That pattern underscores a regime where valuation support is thin and any hint of slower growth, capex strain, or margin pressure in an environment of higher rates can trigger sharp derating. Looking ahead, the sustainability of this earnings cushion will be critical as long-dated yields stay elevated. On the positive side, cloud and AI-related revenues at Microsoft, Amazon, and others are showing tangible payback, and consumer demand at companies like Starbucks and Chipotle remains resilient for now. On the risk side, much of the AI infrastructure build-out is being financed in a world of higher borrowing costs and tight credit conditions, while memory shortages and elevated component prices are expected to persist for 1.5 to 2 years, keeping input costs high. The next wave of results from big tech, energy, and rate-sensitive sectors will therefore either validate the market's willingness to look through higher yields or expose how dependent today's valuations are on a narrow group of outperformers, which brings us back to the geopolitical and energy backdrop, driving a large part of the inflation story. Geopolitics has moved back to center stage, and the latest developments suggest that any earlier talk of a durable truce was premature. Renewed military escalation in the Middle East, combined with incidents on NATO's eastern flank, is keeping an energy risk premium embedded in both inflation expectations and bond markets. Brent crude has pushed back above $90 per barrel after fresh U.S. strikes on Iranian targets, while shipping and pipeline disruptions are increasingly global rather than regional. In the Gulf, the conflict involving Iran has stretched beyond 6 months, with no clear resolution. U.S. airstrikes on Iranian military assets and Iranian-backed attacks in places such as Kuwait and Jordan underline the widening footprint of the confrontation. Traffic through the Strait of Hormuz remains well below pre-conflict levels, with many vessels still avoiding transit, while some LNG shipments have resumed along Iranian coordinated routes that shippers now see as relatively safer. Further west, the first attacks on LNG tankers off Egypt since the fighting began, together with ongoing disruptions in the Red Sea and Mediterranean, highlight how shipping threats are spreading across key choke points. Against that backdrop, physical energy balances look increasingly fragile. U.S. commercial crude inventories are at their lowest since the late 2010s, and the Strategic Petroleum Reserve sits at levels last seen around 1980. With ongoing drawdowns projected to reach a critical inflection around September for the WTI market. Refiners are running flat out, with utilization in the mid to high 90s and even above 100% in some cases, Yet gasoline and diesel stocks are at multi-year lows as plants prioritize jet fuel and middle distillates. Wholesale gasoline has surged to around $140 per barrel, implying refining margins near $70 and underscoring that the tightness is in products rather than crude, while the complete halt of Russian diesel exports has removed roughly 11% of global diesel supply. The macro implications are significant because these are largely supply-driven shocks that central banks cannot directly offset. Businesses, particularly in the United Kingdom, are expected to pass higher energy costs to consumers only gradually, but even that slow pass-through is projected to add around 0.5 percentage point to inflation in the second half of the year and keep headline rates above 3%. Policymakers stress that the balance of risks around inflation is skewed to the upside due to the interaction of energy, supply chains, and potential weather events, reinforcing the case for keeping policy restrictive and limiting room for near-term easing. Sector-wise, energy producers and traders such as Shell are benefiting from high refining margins and volatility, while travel and shipping-exposed companies, including cruise operators, face weaker demand and higher operating costs as routes are rerouted and security premiums rise. Beyond the Middle East, geopolitical flashpoints in Eastern Europe are also feeding risk premia. Reports of a Russian missile crossing into Polish territory and the possibility of NATO consultations being triggered illustrate how quickly security incidents can spill into broader market volatility, particularly for European assets and safe havens. Looking forward, investors are watching for any escalation in attacks on energy infrastructure, further tanker incidents, or shifts in shipping patterns through key straits, as well as central bank commentary on how they will respond if these shocks trigger second-round inflation effects. Taken together, a fragile energy balance, elevated long-term yields, and a narrow earnings leadership point to an environment where macro and geopolitical surprises can reprice risk quickly across asset classes. To sum up, long-dated bond yields are testing 19-year highs as markets challenge central bank credibility. Strong but concentrated earnings in cloud, AI, and select consumer names are offsetting some of that pressure, and renewed geopolitical flare-ups are keeping an energy premium embedded in inflation and policy expectations. Cross-asset positioning now hinges on how these three forces interact, whether policy communication stabilizes yields, whether earnings breadth improves beyond a handful of megacaps, and whether energy and shipping risks ease or intensify. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.